pensioners brace for changes as deeming rates increase. In a significant shift that could impact many retirees, the government has announced an increase in deeming rates for pensioners and welfare recipients. This adjustment aims to align these rates more closely with the current returns on investments, a move that has been long anticipated since the freeze on these rates was put in place at the beginning of the pandemic. On Wednesday, Federal Social Services Minister Tanya Plibersek revealed that starting from September 20th, the lower deeming rate will rise from 0.25% to 0.75%, while the upper rate will increase from 2.25% to 2.75%. This change marks the end of a period where deeming rates were kept at historically low levels to protect pensioners from the dual challenges of rising inflation and interest rates that had inflated returns on various asset classes. Understanding deeming rates. But what exactly are deeming rates? These rates represent the income the government assumes individuals earn from their financial assets when determining their eligibility for pensions and other welfare benefits. Introduced in 1991, deeming rates were designed to prevent pensioners from intentionally keeping their assets in low-yield investments to qualify for government assistance. Typically, these rates are linked to the cash rate set by the Reserve Bank, while also considering other economic indicators. Since 2020, deeming rates have remained frozen at pandemic-era lows, which has effectively saved age pensioners approximately $1.8 billion. As Australians begin to feel the positive impacts of inflation easing, the government will now gradually return deeming rates to pre-pandemic settings, Ms. Plibersek stated, indicating a shift towards normalcy in financial assessments for pensioners. How deeming rates function. The new lower deeming rate of 0.75% will apply to assets up to $64,200 for single individuals. For any assets exceeding this threshold, the higher rate of 2.75% will be applied. In the case of couples where at least one partner is receiving a pension, the lower rate will apply to the first $106,200 of their combined assets before the higher rate takes effect. It's important to note that the assets considered in this calculation include superannuation, shares, bank accounts, term deposits, and more. These deeming calculations play a crucial role in means testing for various government welfare payments, including the age pension, job seeker, and parenting payments, as well as eligibility for the Commonwealth Seniors Health Card. Upcoming changes to deeming rates. The increase in deeming rates set for next month is just the first step in a series of planned adjustments aimed at returning these rates to pre-pandemic levels, according to Ms. Plibersek. After September 20th, the Australia Government Actuary will determine the rates, although the government will retain the authority to make changes if deemed necessary. Coinciding with this date is the scheduled indexation of welfare payments, which will see increases in the age pension, disability support, and carer payments by nearly $30 a fortnight for single recipients, while couples on a full pension will receive an additional $22.40 each. Reactions from pensioners. The upcoming changes have raised concerns among some older Australians. The Council on the Aging, CODA, has expressed that the adjustments to deeming rates may come as a surprise to many pensioners. CODA's CEO, Patricia Sparrow, emphasized that any reduction in fixed incomes can be challenging for individuals to manage. However, she noted that the phased approach to these changes, combined with one of the largest pension increases in the last 6 decades, should help mitigate the impact for many. Older Australians have expressed a desire for transparency regarding the government's plans, allowing them to better forecast and prepare for their financial futures. The gradual implementation of these deeming changes, along with advance notice, indicates that the minister is attentive to their concerns, Ms. Sparrow remarked. CODA will be closely monitoring the government's methodology for setting future deeming rates to ensure it serves all older Australians, particularly those who may not have access to higher interest online savings accounts. Deeming rates should reflect the actual returns individuals can obtain from their banks, not just the advertised online rates. We look forward to collaborating with the actuary to ensure that traditional banking products are accurately represented, she added. In conclusion, as these changes unfold, it raises important questions about the financial well-being of pensioners. How do you feel about the adjustments to deeming rates? Do you think the government is doing enough to support older Australians during this transition? We invite you to share your thoughts and experiences in the comments below.